All right, let's get this show on the road. Thank you so much again for being here. I've been told there are only a few things that are certain in life, and taxes is one of them. So it's going to be a really entertaining panel, and I look really forward to hearing more. Thomas, I'll let you take it away. Thank you. Let's give them a round of applause.
Thank you very much. Yeah, after this legal roundtable, I think we, as you say, so the life gets regulated more and more. But what it's really you cannot avoid is death and tax, and that's why we have this tax roundtable. I'm Thomas Linder. I'm a tax partner with MME, and we will talk today about VAT, value added tax. VAT is a very special tax, actually. So if you think about lawyers and tax advisors and you think they are weird people, usually VAT advisors are very special people, right? And so is our panel very special. So I have with me Sabrina. She's a tax manager with KPMG. And she's there in the financial services team, and she has actually just published a thesis about the VAT qualification of NFTs. Then we have Rakesh. Rakesh is a manager of accounting and tax at Chorus One. Chorus One is one of the biggest institutional staking providers, operating on a lot of networks like Ethereum, Solana, and Cosmos. And we have with us Kevin. He's the head of finance at Safe, a trusted decentralized custody protocol on Ethereum, formerly known as Gnosis, Safe. So our agenda is we will have a very short introduction to VAT, because maybe not everyone knows kind of how VAT works. And then we will discuss the token qualification from a VAT perspective, and the qualification of staking and mining, and the respective issues that we have in this regard. So a short introduction to VAT. The main purpose of VAT is actually to tax consumption. So it's the consumption in a very specific territory. So it shall tax the non-business use of goods and services, for example, in Switzerland, and the end consumer should bear this tax. And to achieve this, you have a very complicated kind of procedure, because how should you know if you sell something that you sell it to the end consumer? So if you sell a bread, that the buyer really eats the bread and consumes it, and then it's gone. But maybe he buys the bread and then he makes a sandwich out of it, and then he sells the sandwich again. So he's not the end consumer in that value chain. So VAT tries to tax every phase of a value chain, and that's why with its value added, and that's why it's called value added tax. So you tax always actually the turnover, the remuneration on one hand, and then if you are not the end consumer, you're again able to get the refund of any VAT that is charged to you. So then you are only taxed on your net value added. But the main point is you always tax the full turnover. In comparison to profit tax, income tax, there you only tax the net profit, and if you have a loss, then it's zero. Here, it's always 100% of the turnover is subject to VAT. Even if you are in a loss situation, they don't care. And you have this example here. So if a taxable person A sells, let's say, a bread to taxable person B, you charge VAT. Then taxable person B sells again the sandwich to the consumer, charges VAT. At the same time, is able to deduct the VAT that was charged to that person, and with that it adds up to the total taxation on the end consumption. In Switzerland, we have a rate of 7.7%. That's quite low compared to other jurisdictions. In the EU, the lowest is 15 in Luxembourg, and I think in Hungary it's 27. So if you need to pay 27% on your total turnover, that can be quite a substantial amount. And if in any of these kind of phases you have an issue with claiming back, with documentation, with kind of charging it to the recipient, then you're just left with this big tax amount, and that can be quite hurtful. So with that, we jump to our first topic that is DLT related. So Sabrina, can you please set the scene a little bit for us and provide the audience with a general understanding of the Swiss practice related to the qualification of tokens?
Yes, thank you. So very generally, the Swiss Federal Tax Administration distinguishes between three main categories of tokens. And the first category are payment tokens. They are equivalent to cryptocurrencies and serve no other means than payment purposes. And they are not linked to any development project or something like that. Then the second category are utility tokens, which are basically intended to provide an access to a digital application or platform. And lastly, we have asset tokens. And there, for example, they entitle the holder of the asset token to a certain share or portion of a profit or turnover or any other derivative rights. And this is based on a contractual legal relationship. So we now have the three different types of tokens. However, it is also possible that the token has multiple functions of the mentioned tokens. And this is then called by the Swiss VAT authority a so-called hybrid token. And for hybrid tokens, we have two general rules. So the first one is that if we have an asset token that also has functions of a utility, it is usually assumed that the investment character is predominant, and so it is rather treated as an asset token. And the second rule is that if we have an asset token or a utility token with an additional payment function, the payment function is usually not assumed to be the predominant character, and it is rather treated as either asset token or utility token. So this was very high level about the token qualification.
So it sounds like this is the same like the regulatory FINMA qualification, like everyone knows payment, utility, asset. So I just go with that. FINMA tells me it's a utility, and then I know how to deal for VAT.
No, that's unfortunately not the case, and this leads us also to our next slide, which is a pretty amazing overview from MMA, which shows on the one hand side the VAT treatment, and on the other hand side the FINMA categories of different tokens. And the FINMA has actually, as Thomas said, the same three categories: payment tokens, utility tokens, and asset tokens as the VAT authority. However, this can mainly be an indicator, but the definitions by the FINMA and the VAT authority are different. So if you have a classification of a token by the FINMA authority, this does not need to mean that the VAT authority has exactly the same. So when we start with a payment token, the use of a payment token for VAT purposes is generally out of scope, with one exception, and this is the professional trading of payment token, which is a Swiss VAT exempt without credit. And then when you have the utility tokens here, the sale and purchase of utility token is generally taxable if the place of supply, which is usually the recipient of the the domicile of the recipient of the utility token is in Switzerland or Liechtenstein, and if there is no exception to this taxability. So an exemption, for example, would be the initial sale of an NFT by the author itself, if it is a natural person. So this would be Swiss VAT exempt without credit under this author exemption. Another very important point to mention for utility tokens is that there needs to be a clearly determinable current or future services linked to this token. If it is not, then it's more like a voucher of value, and then we're back at the treatment of a payment token, which is out of scope for Swiss VAT. Lastly, we have asset tokens, and the trading of asset tokens is also Swiss VAT exempt without credit. However, there are other issues here or considerations, and this can trigger regulatory considerations and also potentially stamp taxes. So this was a really high-level overview of the VAT treatment and the token qualification, but there really needs to be a case-by-case assessment of each token. So the VAT practice of the Swiss Federal Tax Administration is still quite new and also has some gaps. So a token can be so unique that it doesn't fit in either of the three categories. Or, as we will discuss later, I think that the functionalities of the token can even change over the time. Yeah, I think that was it.
Excellent. Yeah, I think where we can be quite sure that if we have a token that is really a mere currency, that the FINMA and VAT qualification is the same, so it's a payment token. And on the other hand, if we have real financial assets like shares, bonds, fund shares, contractual rights, then we're in the asset token category also for both. But everything in between can be kind of one or the other. So you have native tokens, you have vouchers, you have vouchers of value, voucher of supply, etc., NFTs. So most probably they are qualified as utilities from a FINMA perspective, but from a VAT perspective, it can still be a payment token or a taxable utility or an exempt utility. So you really need to go into details in order to get a result and document it very well. And this separate VAT qualification is really needed. So you cannot just do the regulatory stuff, pay the lawyers, and forget about tax. Now, if you have difficulties in determining the VAT qualification, so what are the consequences if the taxpayer just does not declare any taxes or disregards the compliance duties? Maybe Sabrina?
Yeah, that is indeed a really important question because there can be severe consequences. As a first point, the VAT authority can go back 5 years and charge you the VAT on your taxable sales. And the second point that is also important is that it will in many cases not be possible to charge your clients with this additional VAT because the transaction is maybe 5 years ago and you maybe don't even have this client relationship anymore, or the client is abroad and it's going to be a really difficult exercise. And in many cases you will have to have this VAT expense as a final financial burden on your side. And then the third point is that there is a late interest of 4%, and on top of this VAT of 7.7%, which also accumulates over the year. And finally, last but not least, there can also be fines. This can start with 10,000 francs and go up to 6 digits, really depending on the severity of the issue. So it's really recommended to do a proper VAT analysis and get in touch with the tax authorities if there are any uncertainties.
Thank you. How to deal with dynamic token characteristics? Maybe, Kevin, you're involved in a decentralized project, and often token features are quite fluid in a way. So they might be added, they might be removed, maybe by a DAO decision or similar governance structure. So how does this impact the VAT position at the level of the project or the issuer?
Yeah, that's actually really, I think, a big current discussion point. So far, probably, I would assume there's not much guidance available also from the authorities. But if you just look at, for example, current discussions in the Uniswap governance with Lido, where it actually is about, for example, with Uniswap to enable protocol fees. With Lido, it's potentially introducing some staking mechanism and eventually also distributing protocol revenue to token holders. Yeah, this quite drastically actually changes, I think, the features of the token. And if we just, let's look at SAFE, for example, we are right now a pure governance token, nothing else. That, of course, allows you to make up a certain assessment, but on the other hand, of course, for all projects which are currently based on pure governance tokens, they in the end need to find a narrative, a storyline for the token holders, and this is essentially will come down to token utility discussions, and that essentially will also or potentially lead in new features, new value streams attributed to token holders. And then, for example, you could be in a position where you move from a utility, so for example, a taxable voucher of supply, or maybe you are actually currently just a voucher of value, so in that sense, a payment token for VAT purposes, into something likely hybrid, of a hybrid nature. But as you just outlined, Sabrina, if then, let's say, the predominant reason why you acquire this token is actually getting some financial rewards, you probably an asset a token for VAT purpose, and that, as we can see here, has a drastic impact on, for example, the recovery of input VAT, because you can lose actually the entitlement to get the VAT credits. So ultimately, yeah, being, let's say, a finance practitioner in crypto for a couple of years, it's also VAT is probably one of the most relevant risk topics you need to monitor, actively manage, also inform your founders that you need to build provisions. You need to actively, and also, like, I think very important, we talk here about the Swiss regime, but we all know crypto is global by the very start. And that said, yeah, I think it's really important that especially usually the finance officers you have on board have this on the roadmap and monitor this very actively. I hope that's a good first answer to this very broad and I think very relevant discussion point. And also just last comment here, like if you go to the Uniswap forum, they completely neglect this aspect, and often these discussions are also moderated from a non-European perspective where you don't have VAT. But as I said, projects are global and they will likely run into these discussions.
Yeah, I think your comment about the territorial aspect is very important, because VAT usually, but depending on the underlying supply, kind of is due in the country where the recipient is located. So if I sell it to a Swiss guy, then I charge Swiss VAT, but if I sell my governance token that might be taxable to someone in Germany, then most probably I need to apply German tax law, and then it's a question who is actually liable to it. Is it the recipient or the buyer or the seller? So there are a lot of rules that can change depending on the qualification. Now, as a risk management tool, can I get a ruling from the tax authorities? And if yes, does this solve my issues, or are there any kind of also disadvantages of getting such ruling?
I think overall it's certainly an option how to deal very actively with this risk feature. But I think, as you already a bit, I think, indicated or implied with your question, or the second part of your question, it's not the holy grail, so to say. Because what if, let's assume You seek clarity, fiscal clarity, you get a ruling in place for your governance token, and it's labeled, look, it's basically a membership right. That's why basically every single transfer use of the token is equal to a taxable transaction for Swiss VAT purposes. And you have all the rights to get the VAT, input VAT returned, refunded. But then, 1 year down the ladder, so to say, down the roadmap, you introduce some profit sharing, revenue sharing mechanism. Then you're more an asset token. Can you still actually, it could be beneficial though, huh? Is it then fair that you can still keep basically getting the refunds because you have a ruling, or is it then actually more accurate that you need to get back to the authorities, actually file a second ruling based on the currently applicable facts and circumstances? Or actually it can be also the other way around, that you might have in the beginning no refund right, but then you gain one and maybe the authorities have hard times to recognize this entitlement. And then of course, yeah, we are a democracy, we have well-established legal procedures, but hey, what does this industry not have is time. We are really fast-paced, and if you need to go through legal procedures for 3-4 years' time, maybe your project is already gone, especially VAT at 7.7% on the turnover, so on the top line, not the bottom line. So
I
in short,
agree.
it depends.
So in my view as well, you always need to do the analysis at the time of transaction, and if something changed from a functional point of view, then it might also have a different qualification in later transactions. Maybe Sabrina, is this qualification and the ruling discussion only relevant for the issuer, or is it also relevant for exchanges, banks, custody providers, kind of on the secondary market?
Yes, it's truly also relevant for the exchange, because the exchange also has to make this token qualification for all the transactions with the token he supports. And there we have the problem that depending on the amount of tokens that are supported by this exchange, this can be a massive exercise to do all the token qualification. And this is not only a one-time exercise, because we heard the functionalities can change over time. So you have regularly to do a reassessment of these token qualifications to be sure that you have the right VAT assessment in place. So it is actually really much recommended for any exchanges to do a proper VAT analysis and be sure about your risk that you're doing before starting trading, especially with taxable utility tokens, for example, and also all the other tokens. And another topic here that we have is the issuer maybe goes for a ruling for the token qualification. However, this is not the public information. So the exchange basically has to do every token qualification from scratch by himself. So here it would also be a discussion whether it would be helpful or not if the tax authority actually would make such rulings public about the token qualifications.
Yeah, I think that's a big issue. So there are rulings for certain tokens. Some you know because you know the project, so you know the qualification by the tax authorities. In other circumstances, you don't even know that the ruling exists, and maybe you treat it completely different. So, but that's it's very important. We had certain cases where banks or exchanges wanted to list a token, and then they run into an issue that the token was qualified as utility, and it would then be a taxable supply. And if you need to deduct 7.7 from your margin, then most probably the margin is already gone. So that was then a big issue there. And is it also possible to change a ruling or to change? So if now an exchange come to a totally different conclusion, or the functionality has changed slightly, etc. So is it possible that you go back, or that the exchange then goes to the tax authorities and asks for a different treatment than the initial kind of issuer?
Well, personally, I haven't experienced that, to be honest. But in the end, right, and you are here the expert, I think more, but my understanding is in the end, a ruling is something issued to a specific party. The question would be then, like, if, let's say, a year ago, you got a certain qualification, it got requested, for example, by the token issuer, right, in preparation of certain market activities, and then 1 year later, basically, an exchange would ask for a ruling, right? And now the tax authorities, to a different legal party, obviously, right? Because it's a different requesting entity, comes up with a different outcome. Logically, you would expect that the token issue would be notified, but in the end, I could also imagine maybe then if you have a different tax commissioner looking at this, I'm not aware how such information is shared within the authority. I think there could be, I guess, a risk that you would then run basically parallel different rulings and different perspective, which can collide, obviously.
Yeah, in my experience, so the Switzerland is quite diverse, also in languages, etc. So in my experience, if you ask in French the tax authorities, sometimes you get different answers than you ask in German, because a different tax commissioner is then responsible. So we had this case that a ruling was filed in French. There was an answer that was not beneficial to the project. So then we refiled it actually in German, and certainly with some different facts and circumstances or some add-ons. And then the answer was in our favor, and the first one was kind of turned. So it really depends who is looking at it, and even the language can play a role.
But in that case, it was the same requesting entity, right?
The same party, yes. Yeah.
One remark here is just the Swiss VAT is a self-declaration tax, so it's always your risk. And if you have a ruling and the facts and circumstances of this ruling change, as you have mentioned, this ruling is not binding anymore. So in fact, it's your obligation to go for another ruling, or if you know that the treatment is different, apply the other treatment.
Cool. So, to involve Rakesh as well, we will change our topic to staking and mining activities and related VAT issues. So you're with Forest One, a staking provider, so maybe you can highlight to us the complexity of the procedures, of the parties involved, of the transactions, and the related kind of issues also to qualify it from a VAT perspective.
Right. Yeah, so when you look at this slide, I think a lot of the things that already have been said by all the other participants comes together. So if you look at staking, you have a delegating party, and this could be an institutional party, it could be a retail client. You have a validator, that is usually a firm that is based in a certain jurisdiction, so identifiable. As Chorus One, we're a Swiss-based validator. And then you have the blockchain, basically the protocol that you're validating. The complexity that you have here is, if you look at the rewards that you get as a validator, let's say for validating, let's say that is 100%. Usually what a validator does, it takes a certain percentage, which is usually around 5 to 7%. And then the rest goes to the delegator. That's the party that actually delegated the tokens. If you have the scenario of VAT of 7.7%, then it's not very difficult to see that you're immediately loss-making, because you have to pay 7.7% on the 100%. Now you could argue and say like, well, we don't know for sure that the delegator is a Swiss party. And that is, I think that is a very valid argument. However, the nature of blockchain is obviously you have wallets and they can be all over the world. And it's difficult to trace the geographical location. So in that sense, there is a certain ambiguity there of like, how do we solve this problem?
Yeah, I mean, if you look at the validator as a kind of service provider, I think the first question is, anyhow, is this a commercial activity under VAT rules to stake or to mine in a blockchain or a protocol? And there are different views on that. So Switzerland says yes, it's a commercial activity. According to my knowledge, Austria says no. It's no commercial activity because you don't know with whom you're dealing, because you're just validating transactions in a network that is anonymous, and you don't know who is actually the recipient of your service. So they say no, but Switzerland says yes. So that puts it ourselves or you in a position that you should know with whom you're dealing, because depending on the location of the recipient of your services, it might be subject to Swiss VAT, foreign VAT, or no VAT at all, right? And how do you deal with that? Or kind of, I mean, you're validating on a blockchain with a lot of nodes all over the world. On the other hand, you have users that use the blockchain, initiate transaction in this network all over the world. You have delegators delegating to yourself. So how do you deal with that?
Yeah, that's a very good question. And I don't think there's like a very straightforward answer to that question. Because this is a dialogue that you need to start with your tax authorities, in our case in Switzerland, to see like, okay, so obviously the scenario of paying 7.7% on the total revenue is something that would be very easy to do, but it's immediately loss-making, and we could not be competing with other validators if we raise that percentage significantly. So then you have to think about maybe economic activity, or if you can say about the blockchain, so where is the blockchain located? Do we have some kind of way of thinking? Is there maybe we can look at the nodes, the geographical location of the nodes that is sometimes identifiable. So in what I said before as well, you actually need to analyze this very much case by case. And you also need to come up with a customized solution by starting the dialogue with your tax authorities. If you look at, for instance, Germany, where the tax rate is around 20%, that's even more difficult, right? So there is a huge challenge in that sense for us to be proactive, because if we do nothing, then as Sabrina already said, you can get fined. These fees, they build up. The transaction is due to the transactional nature, so that the payable amount rises, and that is something that you don't want to have in your from a cash flow perspective, of course.
Mm-hmm. In the practice of the tax authorities that is published, there is kind of a statement that if a validator is validating a transaction, such validator does have a direct relationship with the user that has initiated this transaction in the protocol, because the transaction fee that is paid then is distributed to the validator through the protocol. There are different views, mine as an example. So I say that there is never a direct relationship because you don't know. So the validator just deals with the blockchain as a whole, with the network. And you need to look at the protocol and the network and determine the location of the nodes. And if the nodes are predominantly outside of Switzerland, then actually the whole transaction should be performed outside of Switzerland, because there is no consumption here in Switzerland in such case, because I provide block information. The block information is distributed to all the nodes, and that's it. So that's actually the recipient. The user, on the other hand, he has a different relationship also to the protocol, and it's actually an additional supply. But that's kind of a discussion we have here in Switzerland. But I think there are, as you mentioned, there are practical solutions to this issue. The tax authorities are very open because they know that it's actually not a solvable problem. So they're very open that you use certain analytics to figure out what is the distribution or the probability of distribution in a certain network. And then maybe I think for Ethereum, you come to a conclusion that 0.8% to 1% of users or nodes are located in Switzerland. So you charge 7.7 on this 1%. That's quite a low amount. And then 99% would be exempt because it's outside of Switzerland. So that's then a practical solution, I guess. But most probably you need to get the ruling for such solution, right?
Yes, definitely. So working with parties such as yourself, it helps a lot to kind of start this dialogue and to actually get this ruling. If you look at the way the rewards are, so the staking rewards actually consist of block rewards, but also transaction fees. And the treatment there can also be different. That is also practically a huge challenge to actually have a good estimation, depending on the blockchain, because some blockchains actually have that very organized in buckets, whereas others you just need to kind of like model or estimate this. But this is definitely an added layer of complexity that you mentioned already.
Yeah, as an explanation, so again, tax authorities say the transaction fee is paid by the user, so there is a direct relationship with the transaction fee. However, the block reward is created by the protocol and not paid by the user. So depending on the circumstances, you need to treat them differently or not. So that's then the question. But it can get quite complicated. Kevin, maybe you, again, from a decentralized project point of view, I think you have similar issues, right, with evaluation of location of service recipients, etc. How do you deal with that?
Yeah, absolutely. And in the end, of course, so to say, we at SAFE are somehow lucky that we don't have staking activities so far. But yeah, of course, like I think in general speaking, in our case, it's way more straightforward. We try, for example, like what's the most apparent case here is like, for example, if we do grants, hackathon awards, right? Like that you just play, especially as a Swiss foundation, also a bit play by the established rules of KYCing the counterparties. But of course, right, also know from other circumstances, like if you do, for example, roll out certain community reward programs like aka airdrops, you can go down the regulated way, basically by involving like a KYC service provider. Opening here the bracket probably also makes a lot of sense given in light of today's sanctions laws. Also, I think since last March, I think things haven't become easier, let's put it that way. So I think that's a way how you can tackle it, right? That you really try to identify the parties to the extent possible. But then if you really look at decentralized network operations like staking, you need to find, let's say, a way, and I think as you outlined, it's about like looking where are my nodes. I think, Rakesh, I think you also highlighted an interesting approach by comparing certain I think size of economies to global or regional relatives. I think it's a bit like open for creative ideas. probably what you need to be aware of, like that it's really like a scalable process. Like you can also run consistently, because I think I would heavily guess that if there's one thing the authorities do not appreciate, if every other quarter you come up with new computations, right? how the value is calculated. But yeah, that's still probably if you want to really play it safe, try to use KYC, decentralized KYC solutions. I think there are also more and more solutions emerging. Yeah, I don't know whether, Rakesh, you want to share some insights?
No, I think you covered that well. I think one of the other things is that, especially in startup projects, I feel like there's a lot of focus on advancing the project, which is totally justified. But these kind of things, as has been mentioned before as well, are things that you need to think about and need to assess. And as Kevin said, like the Swiss tax authorities are very open and very cooperative and understanding. So that is also a very positive trait of this scenario that we have in Switzerland.
Excellent. Yeah, with this positive thought, we will close the panel. I think there is now a coffee break. So if you have any questions, just please catch up with us somewhere at the coffee machine. We're happy to talk about any topics involved. And thank you all. It was a real pleasure. Thank you.